Hey everyone, Eddie again. So I covered the first two topics in the first video. Go check that out. Now let's do the stock versus options um, theory, and then let's see if you can cover the all the calls and the put sides, meaning the long and the shorts, all of it. So let's go back to the screen, cancel this one out, and we are talking about stock versus options. So let's say if you were to buy 100 Apple stock, right? If you were to buy 100 Apple stock, that's how it comes up. Now look at the cost to buy this. If you go to confirm and send, it will cost you $11,000, and that's by paying only 50% of the total cost. So your total cost is 22%, 22,000, and you're paying 11,000 for it. Because that's again, they give you 50% margin. Securities, stocks, securities are given 50% margin, right? But you get charged for this balance. So the remaining 11,000 that they are giving you as margin, you get charged the margin rate. So remember that. It's not free. This is not free money. As long as you have cash available in your account, you'll be fine. But if you're negative after getting this 50% margin, then you will be charged for margin rates. And we can talk about those rates later. But that's how it's work. That's how it works on the platforms. Now the next thing is you are trying to buy 100 stock of Apple, right? But you don't have $11,000 in your pocket. So what do? Well, for the same kind of exposure, because let me just show you the deltas that comes with buying 100 stock. Each stock has one delta, a delta of one, fine. So let's go and analyze the Greeks. There are no Greeks on this, but there's a delta of one. So when the stock price goes up by one, you make $1. Um, uh, Depending on how much stock you have. So you have 100 stocks, right? So if the price goes up $1, you make $100. If the price goes up by $2, you make $200, right? So that they have a delta of one. Each stock has a static delta of one. It's called static because it doesn't move. It's always one, either on the downside or the upside. If you're short a stock, it's one delta static. If you're long, it's one delta static. It doesn't move. There it is. You can see your deltas here. So you're buying 100 stock, your deltas are 100. You don't have any of the Greeks because no option is involved, right? Actually, it's always good to like open up your slices and then just make sure that you understand all these numbers. So you're currently sitting at zero line. This is the line you have to look at. Let me bring a pen out. So this is the line you have to look at here. 100. These are your deltas here. 100. Nothing else because there are no options involved, right? So then why would you? So you don't have the money. Let's say, for example, you don't have this buying power, like which is it's asking you to put down $11,000. You don't have this. So then you go into the options market to get a similar exposure. So now you need 100 deltas, right? That's what you're trying to get. 100 deltas. Now, how do you get 100 deltas in the market? Couple of ways. So you can go into this, whichever expression cycle, we will talk about those later, but this is the monthly one, so it's easier. This is the 50 deltas. Always look at this column here. This will give you 60 deltas, meaning compared to the 100 deltas, this you will get 50 deltas if you buy, or 66 deltas if you buy this call option. If you want exactly one for one, this is the price. This is the strike price you need to buy. One of these, 97 deltas here. So let's say if you were buying 200, the 200 strike price, one options contract, right? Now this will control 100 stock, so you are one for one on the number of stocks that you were trying to buy. But look at the debit that you're paying. You're paying $2,500 to get this stock, to get this options contract, and you get 94.63 deltas. So it's still not 100 deltas yet, but you can buy 100 deltas going in the market, and you can either live with 94, 95, whatever. The next thing you need to know is the amount of money you're putting down for the exact same exposure. So if you were to confirm and send this, you're putting down 2,500 plus, the 65-cent charge for one contract, and this money can be lost when the option expires. If it expires out of the money, your money is lost. If it expires in the money, you obviously make money. Compared to $11,000 that stocks the broker was asking you to just put down for stocks. Both of them have got a 50-50 chance. If you buy the 50 delta strike, you have a 50% chance of being in the money. If you buy a stock outright, you again have a 50% chance. The stock static delta that you get does not give you any more probability of success. So you need to understand this. When you buy stock, you don't get a higher probability of success. It's the exact same thing. It's 50% probability of success. You can check it here. Look at the shaded part. It's divided equally. So the stock price can actually go either up or down equally from here with the same probability. So your probability of success is exactly the same. Either you buy a outright stock position or you get a 50 delta position. It's the exact same thing. But with the options contract, you get all the Greeks. So you'll be losing money on theta every day. It will bring in some negative theta, long vega, and then it will give you long deltas that you were trying to get the exposure to, and then some long gammas. That's what the options does for you. Let's bring in the options here as well, so just so we can compare. So let me just go and buy the 220 strike. So this is the put option. Let me go and buy this one again. Bring it back to our screen. And then let's move this back to 1. And then let's compare. So I'm taking the stock position off now. And let's set this up for -10. You can check the probabilities here. It's the exact same thing. I'm buying a 50-60 delta strike here. It gives me the same amount of success rate, which a stock would give me. The only problem with this one is the long call is that it expires. So in 22 days, if this strike price, if this stock price doesn't go above my break even, and I'm not able to close this, I will be negative. Also remember, even if it goes above your break even, it does not necessarily mean that you will make money because you are collecting negative thetas. So you might go $1 or $2 up on that day, but you will be losing on the theta side. If the stock goes down, the volatility will be up, and you have positive volatility, so you lose on that as well. So just remember that if the stock price goes up, that does not necessarily mean that you will be in the money in this call option. So that's why we don't really buy these; we sell these. Anyway, I'll see you in the next one.